Hey, welcome back everyone. It is time for another red hot cover call video. Guys, one of the most frustrating things is not understanding all the lingo and not understanding an in the money option means. I mentor 3 people, guys, and I try to explain to them. We talk all the time about, hey, look, now it's in the money. Now when you buy it back, you want to make sure the time value and all this and that, and you buy it back, expert. It gets really confusing, guys, and I end up spending 30 minutes explaining to them how once a stock gets in the money, how the time value works, the time decay works. Guys, I know it's frustrating, and I'm losing you. So, guys, what I'm going to do, I'm going to talk today about everything that we talk about in terms of buyback. When we talk about an options price, how it has real money, how it has time value, how it uses time decay. We're going to talk about that today, guys. And look, I hope I bring it to you straight talk style where you understand the basics of this so it's not so complicated or confusing or overwhelming such that you don't stick with the strategy, guys. So, hey, look, I hope you learned something today. And for those salty dog cover call writers, I have 2 trades I'm going to show you today, and I think you're going to learn something. But before we get going, guys, I want you to subscribe to the channel. And hey, look, if you like this video today, bang that like button, guys. It lets me know you like what I'm doing. All right, here we go, guys. So again, we are going to explain real money, time value, and how time decay plays a role in all of our options. Guys, we have to understand time decay. When we talk about options, the thing that needs to be hammered is that options have deadlines. And that's why options are so risky, because you can lose real money. Unlike owning a stock that is probably unlikely to go to zero unless you're playing in super high risk penny stocks. For the most part, you own a stock, it's not going to go to zero. Guys, options do go to zero. And this is the time decay chart that you'll want to look at, you'll want to study. See, guys, the option consists of real money and time value. We're going to talk about that on the next slide. But this is the time value sliding scale. When you have that 3-month option or 6-month option, for the most part, the first 2/3 of that option, the time value part will not move that much. So as the stock goes up or down, sometimes your options won't move that much. It's because you have so much time built into it. But look at that time value towards the end of expiration. It drops off like a rock. And that's when time value players really stick it in. Yeah, I know guys that have hundreds of thousands of dollars, guys, and they throw money in to those weekly options because they play the time value part. That time decay erodes quickly. So if the stock's not going to go above the strike price, guys, as it gets to that strike price and it's not going to make it, man, that option price will go from whatever you were paid slowly, then quickly down to zero, guys. So you need to understand how time decay plays in all of our options. But getting back to our option price. Now, guys, our option price consists of 2 things, okay? When you see an option price in an options chain, this is what you're seeing. Real money and time value. So imagine this little capsule being the premium, the option price. Well, that equals real money time value. See, they go hand in hand. And I'm going to explain to you in the next chart how this works within the money, at the money, and out of the money strikes. This is real simple stuff. Out of the money, being there's no real money in the stock, is going to have all time value. At the money has no real money in the stock, so it's going to be all time value again. And then your in the money strikes, guys, you're going to have the in the money portion plus the time value. So I'm going to give you an example of these 3 in the next slide that I think you're going to, that's really going to help you. I'm going to show you the example next, guys. These are 3 quick examples of what I just talked about. Out of the money, pretty obvious. At the money, pretty obvious. Guys, in the money is the one that gets people to scratch their head. It's that real money value. And see how if we got paid $6 for that in the money strike, stock's trading at 50, we rate the 45, we get paid $6. That option in that options chain will be sitting there at $6. Now, guys, here's an example. This example is of a cover call I wrote just last month. The stock was trading, doesn't matter where the stock was trading, guys. I sold the 155 strike. The 30-day window December 15th covered call, I got paid $1.77, guys. So looking at this option, when I executed that trade, I got paid $1.77. At that moment, wherever the stock was trading, it was an out of the money strike. So the $1.77 is all time value. Now look what's happening, guys. So let's fast forward, guys. A little bit of time has passed, and look what's happening to the stock price. It rallies a little bit. It doesn't get over my strike. It starts to fall. Time decay isn't really a factor, so we don't really know if it's going to get to 155 or not. Pretty likely that it is, but guys, as time starts to shrink, that premium is going to shrink. Now at 160, we have no real money in the stock yet because it's not above the 155 strike. So it's still all time value, but guys, time decay is creeping in. Now let's look at the same option in this situation. It's now gone above 155, guys. And now the likelihood of it being above 155 is real. Now, look where we're at on the time decay chart and look at how the real money and the time value equal this option. So the option that I got paid $1.77 for is now trading at $2.50. Right now, the option is $1 real value, $1.50 time value. So now let's take a look at the option as it's moving forward. Now we are still above our strike price of 155. But guys, as time decay starts to slip in, now that time value is starting to shrink. Remember time value on this slide was $1.50? Well now, with the stock not really moving, time value starting to compress, it's not $1.50 anymore. It's 50 cents. And when we move into that final 30 days, final 3, 2, 1 week of time decay, guys, it'll get down to 5 cents or less. And that's where I always talk about buying our options back. This is where the option price is very close to the actual real money in the stock. So that means we can buy back this option and then immediately sell the shares, releasing our obligation, allowing us to do a couple things. We could either sell the stock immediately or we can then write another covered call. Hopefully you can see that, guys, where we start out with all time value. Then as the stock starts to move, that time value is moving based on where the stock is, based on the strike price. So I hope this makes it a little bit clearer. See, this is where I always talk about buying our options back, where the real money in the stock and the option price is really close. This is where I always talk about having my spreadsheets, guys, where I'll actually have the real money in the stock and my premium, the option price, and when it gets really close to where that time value is under a dime, I like to buy it back because what we're doing here is we're alleviating the obligation so we can do something with the stock. We could either sell the stock immediately or we can write another covered call. So in this case, if I were to buy this option back right here, guys, at $1.05, we have $1 in real value, meaning if I buy this option at $1.05 and sell the stock immediately, I'll pay the $1, but I'll get the $1 back when I sell the shares. It's that 5 cents. That 5 cents of time value that comes out of my original premium of $1.77. And guys, on this trade, I would have made in premium $1.72 in my pocket. Then I sell the shares immediately, getting the $1.55, relieving my obligation. Now, some will say, go to expiration, have your shares taken away, all good. And I get it. But if you want to use a buyback exit strategy for whatever reason, whether you want to take risk off the board, you want to buy it back so you can do another trade. Hey, look, you need to understand this concept. Now, guys, I hope I didn't bore you with that, but it is one of the most important things. If you're going to use exit strategies and you're really going to play the game within the game, you need to understand how time value, real money plays in our option pricing. Hey, look, before I let you go, I'm going to show you 2 trades that I've done. But on my spreadsheet, guys, I'm going to show you how I used that exact strategy when I bought back some cash secured puts and covered calls that I wrote. Guys, look in here, right here in the example number 1 with a cash secured put I did recently, I got paid $2.34. I ended up buying that option back at 10 cents. That means, guys, when I wrote that cash secured put, the stock turned the other way. It was going down. It turned the other way. And as it was going away from my strike price, that option price got smaller and smaller and smaller. The likelihood that it would get to my strike price was unlikely. The actual premium got smaller. And when it got to 10 cents, guys, I bought it back, which means I got paid $2.34, paid back 10 cents. So I pocket on that money invested $2.24. In the other covered call examples, notice Whirlpool. In this example, I got paid $2.10. And guys, I bought that option back for 3 pennies. In the other example of Microsoft, I got paid 50 cents. And when the stock went above the strike price, guys, look what happened. I was $2.09 above my strike price. That option was priced at $2.09. The real money in the stock was $2.08. So when I bought that back, I paid 1 penny in time premium. So I subtract that from the original premium I got paid of 50 cents. Guys, I got paid 49 cents for that trade. Hey, look, I hope you learned something with this video on how real money and time value make up the total price of the options we sell. So guys, before I get going though, I did promise you 2 trades and I'm going to be quick on these. Recently, just 4 days ago, guys, I told you that I wrote a cash secured put on Whirlpool. Guys, look at this. Looking at Whirlpool's stock price, I tell you, I always like to sell a cash secured put under support. Why? Because when I think it goes higher, when I think it's going to go higher, I may never get assigned the shares. In this situation, guys, look at this. I wrote a 160 3-week window cash secured put, and look what happens, guys. Whirlpool starts to take off. I got paid $3.77 for this 160 3-week window cash secured put, guys. This stock has rallied from about 160x to 165. And guys, that original option I got paid $3.77 for, I could have bought it under $1. It actually ended up higher, about $1.70. But guys, I can buy this option back, paying $170 for an option I got paid $3.77 for. Pocketing the money, taking the risk off the board. Guys, that's money in my pocket. Now guys, with my win trade, this is a great trade where I saw the stock basing right here. Man, the stock market's going higher. Win, Sands, they all reported great earnings. Guys, this was a great opportunity to buy some shares and then write that deep out of the money covered call, pocketing money. Guys, what I did was, as Win started basing, I went ahead and bought some shares, got in at 145, guys. And when Win started to break higher, guys, I wrote that 165 deep out of the money strike, guys. I got paid $1.70 for that. We're in a market that keeps going higher and higher. Now, I don't know if it's going to continue going higher, but look, this is a great opportunity to stay in the game and write those deep out of the money covered calls so you collect the nice premium plus the stock appreciation. And that's what I did here with Win. I bought the stock at 145, let the stock move a little bit, and once I got into the 150s, guys, and on a strong day, think the stock was up $3, I went ahead and wrote that 165 out of the money covered call, and guys, got paid good money for it. I call that my cash printing machine. And guys, look, if Win goes to 165, I get $20 on the stock move plus the 170. Making money hand over fist. Hey, look, guys, I do hope you enjoy this video, and I hope you learn. I hope you learn something. Guys, if you haven't been to my CTP dashboard website, we got so much happening there. I want you to grab those free spreadsheets I used in my video today. Guys, it's all about the numbers, keeping it in front of you. Guys, I want you to sign up for my CTP newsletter, man. That is free. And I'm going to have exclusive content solely for those members of the CTP newsletter. And guys, it is all about learning. And I hope you did learn something today, because it jacks me up to know that you're learning. And when you bang that like button, guys, hey, look, until next time, I hope all your covered calls are profitable.
All I see is signs, all I see is dollar signs.